Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Earlier across the tape that the Supreme Court is going to let President Trump strip 500,000 migrants of legal status. Let's get the latest reporting on that. Greg Stohr, Bloomberg Supreme Court Reporter. Greg, what did the court rule here today?
So the Trump administration is trying to end so-called parole status for people from Cuba, Haiti, Nicaragua, and Venezuela. And what that is a temporary status that lets people live and work here because their home countries are in crisis, and it's designed to be for humanitarian reasons. And the question was whether the Trump administration could do this categorically rather than on a case-by-case basis. A lower court had blocked the Trump administration from doing this. The Supreme Court today lifted that block. That means these roughly 500,000 people, we don't know the precise number, no longer have those protections, and many of them are subject to immediate deportation.
Who are these 500,000, and did they come here legally?
They did come here legally. They are allowed into the program. They were given this status by the Biden administration, and they have work permits. They are allowed to be here, but it was always understood that this was a temporary program. It was done on humanitarian basis. You have to get into this program, you have to get a U.S. sponsor, you have to get U.S. government approval, and you actually have to pay for your own flight into the country. But again, it was always designed to be temporary, and what the Trump administration says it's doing is we're just ending that temporary status.
Are these widows and orphans, or are they hardened gang criminals? Do we know anything more about them?
Well, it's a big group of people,
yep.
So undoubtedly there's a mix. But unlike some other things, these are not people who just slipped across the Mexican border. They did have to get that U.S. sponsor. The government had to actually approve them. So there has been some vetting of these people going in. It is certainly not the case that, it's unlikely that a big category of them are going to be, hardened criminals, to use your expression. Yep. But we don't know a whole lot, and we don't even, as I suggested, know the exact number of people, because some of them may have left. We know that there were about 532,000 people who came in initially under these programs. We don't know how many remain in the country under that status. Some of them may have some other protected status and maybe aren't subject to immediate deportation, but certainly a big chunk of them will be subject to it.
All right, Greg, thank you so much for your reporting. Really appreciate it. Greg Stohr, Bloomberg Supreme Court Reporter. Appreciate that.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
When you look at the market, we had that 20% sell-off in the S&P 500 earlier in the year as the market was trying to figure out what's going on with the tariff story. The market's kind of retraced most of that coming back up. So now the question is, where do we go from here? So let's check in with Brian Levitt, Global Market Strategist at Invesco. He's zooming in from somewhere in the Jersey burbs there. Brian, what's the message to your clients these days? We've kind of been whipsawed, but if you look back on a year-to-date basis, it's almost like nothing happened here.
It's amazing. It's like if you woke up today, you wouldn't have realized that any of this has been going on. You see that not only in the equity market, but also the bond market. Inflation expectations, real yields, corporate bond spreads are actually not all that changed since the beginning of the year either. We're talking to our clients about having optionality in our portfolios. We don't know which way we're going to be whipsawed, but we also don't want to be out of these markets. So diversification is sometimes a cliche, but it does make sense to try and diversify your portfolio, bring down the valuation. If you're just S&P 500, you're sitting at an elevated valuation. So bring down the valuation of the portfolio, potentially protect yourself. But if things do become better on a policy front, other parts of the market, whether it's value stocks, Europe, mid cap, should do well in more of a recovery type feel. So, heads, hopefully you win. Tails, hopefully you win.
Hey, Brian, can you ditch U.S. exceptionalism for European exceptionalism?
I don't like getting rid of the word exceptionalism because I think that it gives U.S. investors the sense that they shouldn't be invested in the United States. There still are exceptional businesses, and it's still going to be an exceptional economy over the long term. But what you want to think, though, with regards to Europe is there's a couple of things happening. For one, European equities have been cheaper, but generally for a good reason. So you need a catalyst to unlock that. What you have right now, of course, is easier policy out of the European Central Bank than you're likely to have out of the U.S. Federal Reserve. You also have oncoming stimulus from some of the major European economies, and all that's leading to some weakness in the U.S. dollar. So, yeah, I would say we do want to diversify into non-U.S. stocks. Investors in the U.S. have not wanted to do that for a while. I don't think that's trading one exceptionalism for the other. It's more increasing our exposure to the part of the world where I think a lot of people have become pretty heavily underweighted to.
Red headline crossing the Bloomberg terminal I want to get to. The Supreme Court lets Trump strip 500,000 migrants of legal status. So we'll have more reporting on that throughout the day. Brian, what are we doing in the world of fixed income here? I considered it a 2-year treasury and get darn near 4%, which seems like a good living there. Do I take credit risk on top of that?
Yeah, I would take credit risk. 4% is what people used to beg for, and now you can get spread above that on good fundamental corporate bonds. You can get that in a tax equivalent basis on fundamentally sound municipal bonds. So, look, I mean, you don't want to put all your risk into one place, so a diversified mix can help. I think just sitting in money markets, you're missing the opportunity to augment the yield. There's yield pickup in other parts of these markets.
What does that tell you, high yield, at this point about recession risk?
It tells you it's not likely in the cards. I mean, U.S. high yield bonds have been one of the best performing asset classes in the United States this year. When we saw volatility spiking the way we did following Liberation Day, we did see a modest pickup in high yield bond spreads, but still well below the long-term average. That was comforting to us. I still view the high yield bond market as the canary in the coal mine for the cycle. So if volatility is picking up and credit spreads can't even get to average, that's a buying opportunity in our perspective. And it's our view that it's a market that is telling us that a recession is not in the offing, at least in the immediate term.
Hey, Brian, we've seen risk assets, most notably U.S. equities, kind of snap back here from some of the initial shock selling of earlier in the year. We have not seen that in the U.S. dollar. The dollar remains at its, kind of recent lows here. What is that telling you?
Yeah, what it's telling us is that there's still some concerns around U.S. policy, and there's still some greater excitement around being in currencies outside of the United States. So while the U.S. has essentially gotten back to flat, you've seen substantially higher returns in other parts of the market, particularly Germany, other European countries, as well as some emerging markets. So what it tells me is back to that diversification story. It's not a collapse in the dollar, but it's a rebalancing away to some extent, or diversifying away from. Remember, the U.S. dollar was at very elevated levels, and that was based on U.S. growth being stronger than the rest of the world. And that starts to narrow as we have concerns about ongoing trade policy.
Brian, thanks so much for joining us. Really appreciate it on a summer Friday. Brian Levitt, Global Macro Strategist at Invesco.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts, or watch us live on YouTube.
Right now, let's go down to Dallas, Texas. Michael McKee is in our Texas bureau down there, and I can tell you He does all the economic stuff for Bloomberg. We know Michael McKee. Yesterday, he was smack in the oil patch. We're talking like Midland, Odessa, Texas, oil, gas, the setting of my new favorite TV show, Landman. And I don't know what he was doing now. Usually that's Alex
He's
Steele
applying
territory.
for a job as a roustabout.
Michael McKee, a roustabout on an oil rig. Mike, thanks so much for joining us here. We had some economic data today. It seems like inflation, Mike, is still pretty much being contained here. What did you take away from some of the PCE data we saw this morning?
Well, basically, you're right, Paul. We're seeing inflation come down. We're just 0.1% over the Fed's target on the PCE headline. We came in at 2.1% this month. So the Fed is very close to being able to say soft landing, except, of course, for the tariffs and everything else that's going on with the Trump administration. And that's the hard part, is consumer spending held up, wasn't great, but was okay in April after a lot of people pulled forward purchases into March and February. So where do we go from here? That's where the Fed is stuck, because minute by minute we get new court decisions that make the tariffs on, make tariffs off, etc. So they can't really do anything. So we're still in this Groundhog Day of waiting to see what happens next.
All right, so the Fed's dealing with uncertainty too. There's a meeting coming up, the 18th, and this time around we're going to get the little dot things. What are we going to learn?
Nothing. When you talk to Fed officials, and this was, of course, before this last week of back and forth court decisions, most of them would say, take these numbers with a grain of salt. We just have to basically act as if the current conditions are going to last, and we have no reason to think that they are going to, but we don't have anything to base a new forecast on. So I think when you get the decision, the dot plot and the new summary of economic projections, that they will have a shelf life of an hour or so, and then we'll be back to, well, what happens next?
Mike, we also got the University of Michigan data out for the month of May, and we showed an improvement from kind of the shocking decline we saw last month. But inflation expectations, while they've come down, are still pretty darn high here. What would you learn from the Mich data?
We didn't learn a whole lot, except that people weren't feeling as bad about the economy in April as they were, or in May rather, as they were in April. We saw a rise in consumer expectations, but it's still below 50. And it didn't match at all the rise in expectations in the Conference Board survey earlier this week. So it leaves us somewhat in limbo on what people think about the economy going forward. As you mentioned, the inflation numbers come down a little bit, but they're still very elevated. And right now, Conference Board and Michigan match in what people think is going to happen over the next year. Now, the drop in the inflation expectations may be because gasoline prices have come down a little bit and food prices have stopped rising as much. But at this point, people still think that the president's policies are going to be inflationary, and that's the consensus of most economists. So it's not telling us anything new. It's telling us that not much has changed.
Way back when Arthur Burns was called in to meet with Richard Nixon, we know the outcome of that. Yesterday, was it, that Donald Trump met with Jay Powell? What's going to be the outcome of this meeting, if anything?
Nothing, I don't think. Jay Powell reiterated the Fed doesn't know what they're going to be doing, and here's where we see the economy at the moment. The president tells us that he told Jay Powell to cut interest rates, but the Fed isn't going to do what the president asks just because he's asking if economic conditions don't warrant it. What it may be is that if things do turn out better than expected, then Donald Trump can come out and say, well, I told you so, I told Powell so, and they didn't listen to me. But if things turn out as economists expect, then Powell has the better response.
All right, Mike, thanks so much for joining us. Michael McKee, international economics and policy correspondent for Bloomberg News from our Dallas bureau. He's got to get back to New York. Flying back to New York on a summer Friday, what could go wrong? I mean,
Into Newark Airport?
Yeah, I don't know. I don't know where he's going, but I've always avoided Friday traveling in general, particularly in the summer. That's just kind of been my strategy all along. Sometimes it works, sometimes it doesn't.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Let me get the latest on what's happening down in Washington, D.C. When I say the latest, people, we're doing it on a hour by hour basis. I think it's not day to day, but somebody who actually has this is what they do. They kind of tell us what's going on in Washington, D.C., and they're so valuable to us and our audience. Henrietta Trez is the absolute best, managing partner and director of economic policy for Aveda Partners here. Let's just start with tariffs, Henrietta. The courts are kind of going all over the place. What's the understanding in Washington within the administration of kind of where they are these days?
Well, I appreciate you having me on. The administration is preparing for all avenues. And fortunately for them, they have so many available pathways to perpetuate the president's trade wars and to keep the tariffs on. And I think that's why the market is not responding with ebullience today or even yesterday that the IEEPA tariffs have been taken off. The reality is we need to pivot to Section 301, which, of course, was the entire rationale and the authority used to wage the trade war with China in the first Trump term. We need to get very seriously in the weeds on sectoral tariffs, which are coming across myriad sectors: semiconductors, pharmaceuticals, copper, trucking, air, cargo, freight, the whole shebang. And then we really need to start thinking about stacking those tariffs, what that might mean for individual sectors. And then, of course, some components of the tax bill that also include effectively tariff strategy and authority for the Treasury Secretary. Something that's really captured the street's attention in the last couple of days is Section 899, which creates an authority for the Treasury Secretary to effectively tax entities from foreign nations, including individuals that have unfair trade practices or unfair tax practices on everything from the digital services trade and beyond. So there's a lot still to do. And, the trade wars are going to be a hallmark of President Trump's second term, just like they were in his first.
Okay, did you just tell me that uncertainty is far from concluded?
I think it's ramping up. I mean, we had a brief reprieve when IEEPA was the law of the land, and now we're in, get out your numbers, 201, 232, 301. This is what you need to pay for now, is the expertise around these various specific components. So
I guess there's more avenues for the administration to pursue trade policy, but my understanding is they take much longer than just saying we're going to have a 10% across the board tariffs, which the president can do with the stroke of a pen. What's the timing associated with all this? It sounds complicated.
Yeah, great question. So there are the IEEPA statute was the fastest, bluntest, and easiest instrument that the president could have taken up, and that's exactly what he did. But we have a number of components that are already in the pipeline, already in effect, and also that can easily be effectuated. So, for example, the Balance of Payments Authority, which is something Ambassador Lighthizer, President Trump's first trade representative, talked about in the run-up to President Trump's win in November of 2024, which is immediately impose a Balance of Payments Authority, which is an ad valorem duty of up to 15% for 150 days on any nation where there's a trade deficit. That can happen very quickly. Customs and Border Protection can change tariff rates within 12 hours. So that's something to be mindful of as sort of an IEEPA replacement. The drawback is that it's capped at 150 days unless Congress authorizes an extension. It's my base case expectation that Congress will not authorize that extension, mostly because many Republicans do not support the president's tariffs because, of course, they are taxes on consumers, and they're seeing the blowback in various industries like the farming sector and small businesses and manufacturers who are struggling with the lack of imports from China right now. But compounding that are the Section 232 tariffs that are already in place, including on automobiles and automobile parts. Those rates are 25% for the most part. They can be ratcheted up overnight. The president also has a series of investigations already in the works whose comment period have ended, and they can release their findings and impose new tariffs pretty much at any time now. That applies to the semiconductor space, the pharmaceutical space, copper, and a couple of others. And then I think the most important to be mindful of is Section 301. This is the authority to tariff everything coming in from China. In Trump's first term, we did that across lists 1, 2, 3, 4A. And we haven't done it on list 4B, but this is $550 billion worth of trade, and there is no upper bound on the tariff rate that can be imposed under Section 301 that I've ever been able to find. So we're mostly at 25% now. No reason that can't go up to 50 or 145.
A reporter asked the president the taco question, and you heard his response, I think. The Trump always chickens out on tariffs of this sort. He was angry, and he sounded even more emboldened. What was your take?
It just reminded me of the 2018 escalation. I'm sure y'all remember it at the time. I'll never forget it. The president got upset in the Oval Office, and he escalated tariffs almost immediately and during the hot summer months. We saw that repeatedly throughout 2018, and I think that we're looking at it again here. I mean, these are very emotional, heady times for him, and when he puts these tariffs on and hears something like the street doesn't take him seriously, that's got to be pretty embarrassing. So obviously we're seeing escalation today.
All right, that's tariffs. Let's move on to another areas of your expertise, which is Capitol Hill legislation. We've got a House tax bill, I guess. The Senate's now looking at it. Where are we with that important piece of legislation?
We've got a couple 72 hours before things really kick off on the Senate side. The House passed their bill, as you point out. It is very comprehensive and really thread the needle between a whole host of factions that just don't exist on the Senate side. So, for example, the deduction for the SALT cap is very generous in the House passed legislation, probably about $200 billion more generous than anything the senators will agree to. So that's going to have to be something that they change when the Senate takes up their bill. I suspect it'll probably be about 3 weeks before we see any legislation from the Senate Finance Committee. This is the most critical committee in the Senate, unlike on the House side where we have Energy and Commerce that had to cut I believe it's $715 billion from Medicaid, and then a separate Ways and Means Committee that tackled a $4 trillion tax package. That's all one committee on the Senate side. So we're going to get their package late in the process, probably towards the end of June. They're hoping that they can get legislation through their chamber by the 4th of July, which I think is distinctly possible and puts us on a path to get that bill passed and signed into law by the July 24th recess in the House or the August 1st start of the recess in the Senate.
Since it's breaking news, and do this in 20 seconds, the Supreme Court ruling letting the administration strip 500,000 migrants of legal status. Can you speak to the importance of migrants to the U.S. economy real quick?
Yeah, migration to the U.S. economy is critical for the housing sector. One of the sectoral tariffs I talked about and I didn't mention was the lumber tariffs. I mean, these are critical for the housing industry. And the combination of kicking out 500,000 immigrants and imposing tariffs on lumber has got to be brutal for that whole sector. I really would focus on that.
Henrietta Trez, thank you so much. We appreciate it. Henrietta Trez, Managing Partner and Director of Economic Policy at Veda Partners. Somehow she keeps all that Washington legislation, tariff stuff, tweets. Somehow she keeps it all in focus and she explains it to us because I can't follow it.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.